So, when you think of Aflac, you probably just picture the duck, right?
Oh, absolutely. I mean, the smiling duck on the TV commercial.
Yeah, exactly. But what happens when that duck is actually sitting on top of like a $97 billion commercial real estate and international currency empire?
It's a pretty wild contrast when you actually look under the hood.
Right. Because today, our mission on this deep dive is to go way beyond the mascot. We are unpacking their 2025 annual report, the Form 10K.
And this filing, I mean, it really lays out how this company is a highly sophisticated financial fortress.
Yeah, they are spending their days navigating things like Japanese demographics and high-stakes international currency hedges and even modern digital warfare.
Which is definitely not what comes to mind when you buy a supplemental insurance policy.
Right. So, okay, let's unpack this because if you're operating in the U.S., you know Aflac. They're a household name.
Yeah, the report actually mentions the duck just celebrated its 25th anniversary in the U.S. market in 2025.
Which is crazy to think about. But to really grasp how this operation works, you have to look at this specific graphic in their filing. It says, relevant products sold through expansive distribution yields customers.
Which, sure, sounds like total corporate jargon.
Yeah, it really does. But the mechanics behind it are staggering. Because first, we need to establish what they actually do. They don't replace your primary health insurance.
Right. No, they provide supplemental health and life insurance.
Mhm.
So if you get sick or hurt, they pay you cash benefits directly.
Like to pay your mortgage or buy groceries.
Exactly. The idea is you focus on recovery, not the financial stress of missing work or, those hidden out-of-pocket costs.
Okay, so think of it like a financial moat around your castle for when the main wall, your primary medical insurance, gets breached.
That's a great way to put it, yeah.
But here is why we have to pivot. To understand their real power, you have to look away from the US and look across the Pacific to Japan.
Yeah, Japan is the absolute core of their business.
Right, Aflac Japan is the principal contributor to their earnings. In 2025, it made up 53% of their total adjusted revenues.
More than half the business.
Yeah. So I have to push back a little here. Why is this, this supplemental moat so much more popular in Japan than literally anywhere
Well,
else?
what's fascinating here is the sheer demographic reality that's driving all of this.
Okay.
The report explicitly talks about how Japan is entering an era of 100-year lifespans.
Wow. 100 years.
Yeah, people are living incredibly long lives.
Mm.
But when you have a massive aging population, the ratio of active workers to retirees completely flips.
Which means there's less money going into the national healthcare system.
Exactly. It puts immense pressure on Japan's national system. So the government has to shift more of those out-of-pocket costs down to the individual consumers.
Ah, I see. So as the citizens have to pay more for their own care, the demand for supplemental insurance just explodes.
Right. And Aflac didn't just stumble into this. They pioneered the cancer insurance market in Japan way back in 1974.
They've been there for 50 years.
Yeah, they saw this demographic curve coming decades ago.
Mm-hmm.
And today, they have 22 million individual policies in force in Japan alone.
22 million. That's
Yeah.
a massive chunk of the population.
And 14 million of those are specific cancer policies. They just launched 2 new products in 2025 for this exact market, too.
Okay.
One is called Merido, which is this really flexible, service-integrated cancel product. And the other is Anshin Palette for customizable medical insurance.
But having a good product is one thing. How are they actually getting these in front of 22 million people?
That goes back to that jargon you mentioned earlier, the expansive distribution.
Right.
They don't just rely on cold calling. They sell through 358 different banks in Japan.
Wait, how many banks are in Japan?
Well, that number represents 90% of all the banks in the entire country.
You're kidding. 90%.
And on top of that, they have a massive alliance with the Japan Post Group. That gives them access to roughly 20,000 postal outlets.
Oh, wow. So you literally go to the post office to mail a package and you can buy an Aflac policy.
Exactly. They have woven themselves into the daily errands of the Japanese public.
But okay, this dominance creates a really specific, massive macroeconomic puzzle, right? Because they are collecting mountains of premium revenue in Japanese yen.
Yes, absolute mountains of yen.
And historically, Japan has had extremely low, sometimes even negative interest rates.
Right, which is a huge problem for an insurance company.
Because they can't just leave that cash under a mattress in Tokyo. They have to invest it to get a return so they can pay out future claims.
Precisely. And since they can't get that yield in Japan, they're forced to export that capital. They take the yen and invest heavily in U.S. dollar-denominated assets.
So they're taking Japanese money and buying U.S. corporate bonds.
Exactly, to capture those higher U.S. interest rates.
Yeah.
But the catch is their liabilities, the claims they have to pay when someone gets sick in Tokyo, those are still in yen.
So it's this insane currency conundrum. They are basically riding two horses at once.
Yeah, it's a huge balancing act. In 2025, the average exchange rate was 149.32 yen to the dollar.
And the 10K points out that when the yen weakens against the dollar, it artificially suppresses Aflac's reported results for their U.S. GAAP financials, right?
Right, because you have to translate those yen back into strong U.S. dollars to show the American shareholders, and it just makes the revenue look smaller.
Even if the Japanese business is doing incredibly well.
Exactly. So to survive this, they used what they call the U.S. dollar-denominated hedge program.
Okay, break that down for me. How does that actually work?
They use financial derivatives, foreign currency forwards, and options to economically convert those dollar investments back to yen.
So it's kind of like an airline trying to lock in the price of jet fuel for next year so they don't get wiped out if oil prices spike.
That is a perfect analogy. They pay a premium to lock in a future exchange rate so they have predictability. But hedging isn't free.
Right, it costs money to buy that protection.
And the cost is dictated by the difference between U.S. and Japanese interest rates.
And the text mentioned the Bank of Japan actually ended its negative interest rate policy in March of 2024.
They did, but U.S. rates are still much higher, so that gap still exists. And if the gap widens, the cost to hedge goes up.
Which eats into the whole reason they went to the U.S. market in the first place.
Exactly. The yield they cross the ocean for gets eroded by the cost of protecting it.
Wow. Okay, so this desperate search for yield pushes them into some really complex physical assets, because here's where it gets really interesting.
Oh, the investment portfolio?
Yeah. We are talking about a total investment portfolio of $97.5 billion.
It's massive.
And they don't just buy safe government bonds. They are buying infrastructure debt, middle market loans, and commercial real estate.
Right.
So I have to ask, if they're investing in commercial real estate right now, especially office buildings, aren't they getting completely burned by the whole post-pandemic shift to remote work?
Well, you're not wrong to ask that. The 10K data is pretty transparent about this.
Okay, what does it say?
They hold transitional real estate loans, or TREs, and commercial mortgage loans. And in 2025, they actually had to complete foreclosures or accept deeds in lieu of foreclosure.
Wait, a deed in lieu, that's when the borrower just hands over the keys, right?
Exactly. The borrower essentially says, I can't pay this, just take the building.
So Aflac is literally taking physical possession of office buildings.
Yes. They took possession of properties with an amortized cost of $257 million in 2025.
$257 million? That sounds really bad.
It sounds bad, but here's the surprising part. They only took a $10 million net loss on those properties.
Wait, really? How is the loss so small compared to the value of the properties?
Well, it's actually an improvement. In 2024, they took a $34 million loss. The reason the net loss is small is because they likely already wrote down the value in previous quarters.
Oh, so they saw the commercial real estate market tanking and prepared for it.
Right, they set aside credit loss reserves. Plus, the physical buildings still have value. But the big takeaway here is that this insurance giant is tethered to the harsh reality of empty office spaces.
Yeah, if tech companies don't go back to the office, Aflac feels it. But okay, physical real estate is a traditional risk. Let's talk about their digital wall.
The cyber incident.
Yes, because in 2025, those digital walls were breached. The report outlines a massive cyber attack on June 12th, 2025.
It was a very significant event. Hackers gained unauthorized access to their U.S. systems.
And the numbers are staggering. Data for 22.65 million individuals was exfiltrated.
For 22 million people.
And we're talking claims info, health information, social security numbers, everything.
Which is an absolute nightmare scenario for an insurance company.
So how does that not destroy them overnight? How do you survive a 22 million person data breach?
Well, if we connect this to the bigger picture of how modern cyber warfare works, the incident response is key.
What do they do?
They contain the attack within hours. But crucially, the systems were not affected by ransomware.
Oh, okay, so the hackers stole a copy of the data, but they didn't lock Aflac out of their own systems.
Precisely. Usually, a hacker drops ransomware and bricks the entire network until you pay up. But since that didn't happen here, Aflac's core operational engine never stopped.
They could keep running the business.
Exactly. They continued underwriting policies, reviewing claims, and most importantly, paying out cash benefits without any interruption.
I mean, I guess that makes sense, but surely there was some financial hit, right?
Oh, absolutely. They faced elevated cybersecurity insurance premiums, huge legal fees, and the cost of providing credit monitoring for millions of people.
Which can't be cheap.
It's not. But the company stated in the filing that it's not reasonably likely to have a material impact on their overall financial condition.
Because the cash flow kept pumping.
Exactly, the fortress held.
Which is an amazing transition to the bottom line. With demographic shifts, currency swings, real estate foreclosures, and a massive cyber attack. How did they actually do in 2025?
The financials are really robust, honestly.
Yeah, I saw total revenues dropped a bit to $17.2 billion.
Right, and that was largely driven by $572 million in net investment losses, compared to gains the year before.
But despite that drop in revenue, they pulled in $3.6 billion in net earnings. They are a cash-generating machine.
They really are. And if you look at the comparison of 5-year cumulative total return chart in the report, it's fantastic for the shareholders.
Oh, I love these charts. Walk me through the math.
So if you had invested $100 in Aflac stock on December 31st, 2020,
Okay.
by the end of 2025, that $100 grew to $278.50.
Wow. And how does that compare to the rest of the market?
They comfortably beat it. The S&P 500 only hit $196.
So they crushed the broader market.
Yeah, and they even beat the specific S&P 500 Life and Health Insurance Index, which hit $201.
That's incredible. So what did they do with all that cash they generated? Because they returned a ton of value to the shareholder.
Oh, the buybacks.
Yes, they bought back a massive 33.4 million shares of their own stock on the open market.
Which cost them about $3.5 billion.
And when a company shrinks the number of shares out there, every share you own becomes slightly more valuable. Plus, the board authorized another 100 million shares for repurchase in August 2025.
It's an aggressive capital return strategy, and they increased the 2026 dividend by 5.2%.
So they are taking very good care of the owners.
They are. But the 10K also notes that this financial success is built on how they treat their workforce.
Right, the human capital element.
Yeah. Their philosophy is basically, if you take care of your employees will take care of the business.
Which sounds like standard corporate PR, but they actually have the structure to back it up.
They really do. A great example from the report is the Aflac Heartful Services subsidiary over in Japan.
Right, what's the deal with that group?
It's a specialized subsidiary.
Yeah.
And out of their 158 employees, 124 have disabilities.
That's amazing.
Yeah. It proves that highly inclusive hiring and strong corporate performance actually go hand in hand.
I love that. So what does this all mean? We started this deep dive looking at a quirky duck commercial, and we end up unpacking a sophisticated global financial machine.
A very complex machine, yeah.
You see how they use recognizable branding to fuel a system that relies on Japanese longevity. You've got complex dollar-yen currency hedges, you've got real estate management, and they survived a massive data breach without missing a single premium payment.
And, before we wrap up, I want to leave you with a final thought to mull over.
Yeah, lay it on me.
It goes back to that demographic data. The report explicitly anchors their strategy on Japan entering an era of 100-year lifespans.
Right, which sounds great for humanity.
It is. And right now, Aflac is highly profitable by selling cancer and medical policies to this aging demographic.
Paying out lump sums when an acute illness happens.
Exactly. But as medical science advances and people routinely live past 100, the very nature of sickness is going to change.
What do you mean?
Well, instead of an acute event like a sudden illness that you either recover from or you don't, it's going to shift to the decades-long management of chronic conditions.
Oh, right. If you live to be 105, you might be managing 3 different conditions for 30 years.
Exactly. So the provocative question is, will the current supplemental insurance model paying a lump sum for an illness actually hold up in the future?
When a living to 105 is the baseline normal.
Right. It begs the question, what will supplemental insurance look like in the year 2100?
Wow. That really makes you think about how businesses have to adapt to just human evolution, basically.
It really does.
Well, that is a wild thought to end on. Thank you for joining us on this deep dive. Keep questioning the unseen forces shaping the world around you, and we'll catch you next time.